Good morning, everybody. Good to be back here. Matt Heatwole, partner with Brown Edwards out of the Harrisonburg office. Again, it's interesting to hear Chris say this has been 25 years of presenting on these things, quarter century. That's pretty, we're proud of that for sure. I'm glad we could do this in a web-based format. I think we're reaching a lot of people all over the state and in different states. So again, glad to be here. Hope everybody's morning has started off well. Mine started with our 2-year-old toddler coming in at 5 a.m. saying, "Mommy, Daddy, I slept through the night." And he is correct. He was correct in that regard, but he just didn't realize it was still nighttime. So I'm a little tired, but that's okay. I've got coffee in me, water, all the necessary ingredients. So we're going to jump into GASB 87 again today. We've been talking about it for a number of years, but what I did was try to structure this presentation in my thoughts throughout the presentation from the perspective of it's actually here. I mean, this standard is effective now. It's 2022. We need to get these on the books. We need to be thinking about these. We need to be gathering everything. So that's kind of the approach I took. We will have, a quick refresher on the standard itself. But these are some of our goals and outline and the outline for my presentation. Going to talk about what we need to do to actually gathering these leases. Where do we even start? It's sometimes hard to figure out with this standard, but certainly what we need to do to gather these leases and contracts. Once we get those, what data do we need to extract? What data do we need to be looking at? Some considerations too on your internal policies, your internal procedures, documentation you may want to consider within your organizations. We'll look at actually getting these leases on the books, both at transition and throughout the year, with a few examples I think are helpful. We'll look at some specific disclosures, more just the requirements of the disclosures. What to expect from us as auditors. We're going to be auditing these numbers, these disclosures, so giving you some hints there, what we'll be looking at, and then we'll touch on a few things at the end. So looking forward to it. Okay, so first thing, an introduction and refresher on GASB 87. In a nutshell, and we've been talking about this forever, I think since 2013, 14, whatever it's been, but in a nutshell, almost all of our leases out there are going to be on our balance sheet, the statement of deposition. We're going to be showing a lease liability and a lease asset, a right to use intangible asset. For any leases out there that are greater than 12 months, the term is greater than 12 months. All governments are subject to this, and any entities who follow GASB standards. It is going to be effective for periods beginning after June 15th of 2021. So again, we're in the implementation year. Just a reminder, what did we used to do with these leases? Capital leases, if we had classified those, should already be on your balance sheets. Operating leases are not on your balance sheet. Service contracts are not. And again, the change being most of these are going to be on the balance sheet going forward. Service contracts likely will not be on the balance sheet. We don't have any more what we call the bright line thresholds of old GAAP, where we had, the question was whether it's a capital lease, whether it's an operating lease. We used all of those criteria, the 75% life test, the title transfer test, the bargain purchase, all those are gone under this standard. Just some reminders of what is excluded under this standard. Rights to explore for natural resources, biological assets, licensing contracts, service concession arrangements. Any leases out there that are non-exchange transactions, there is an implementation question or two where, and some of you might have a number of these, where we're renting something for $1 a year. That's a non-exchange transaction, so that does not fall under here. You would continue accounting for that the way you were. Short-term leases, we'll go into what that actually is, but short-term leases, generally less than 12 months, are not going to be included under this standard. And probably most importantly, any contracts you have, any leases you have that specifically transfer ownership of the asset at the end. Those are just financed purchases. We're pretty used to those, right? Debt, asset, and debt. That's how those are going to be accounted for. What are short-term leases? They are defined as at the commencement of the lease term. They have a maximum possible term under the lease contract of 12 months or less. That does include any options to extend regardless of the probability of those. If they are short-term leases, like I said, we're really just recognizing outflows or inflows as they happen, as we have. There are some questions out there. Some of us may have month-to-month leases. And where do those fall in this guidance? And the answer there is what is the non-cancelable period? If that period is less than a year, less than 12 months, it is a short-term lease. I will point you all to, there's actually the standard itself. There's a lease implementation guide that's very good. And then there's been 2 other implementation guides that have a number of questions on leases. And the lease term, short-term leases, and so forth, there's a lot of good examples in those implementation guides. So if you're thinking of a lease and wondering, is it short-term, is it long-term, we have these options. I bet you might find an answer or a similar example in those implementation guides. So always a good, highly recommend that as a starting place. So that's those are some of the refreshers, and so we're going to talk a little about where do we start? And the starting point is definitely gathering leases and contracts. And I wanted to start here by throwing up the definition of a lease. It is a contract, key term, that conveys the control of the right to use another entity's non-financial asset, the underlying asset, as specified in the contract for a period of time in an exchange or exchange-like transaction. Like we said, any leases out there that are for $1 a year, $1 a month, probably not an exchange transaction. But the key term here, contract, right? It doesn't really matter if your piece of paper says lease or if it says contract. A lease could be in there, and you're really going to have to think about what contracts out there you have when jumping into this thing. So some things to think about as you're attempting to gather leases and contracts. I've sat in a number of CPE sessions, read some articles. One of the consistent things seems to be we should be identifying a lease leader or even a lease team in our organizations. That's probably going to start with finance, I would think, but depending on the number of leases you have or you think you have, a team might be necessary to tackle this pretty complicated standard. Want to create a timeline for getting all this done. Again, we are in the implementation year. So my hope is most of you have started to tackle this, and if not, the time is now. As far as what the timeline might take you, I think it really depends on your organization. I've seen examples of 6 months has been a common one. Now they didn't disclose how many leases they have. If you just have a couple or think you have a couple, may not be too bad of a time commitment for everyone, but certainly want to sit down and get started on this. Goes without saying, I think you need to be reaching out to your key departments, especially ones who certainly hold and use assets, certainly schools, education, lots of assets at our schools. Budget, purchasing, procurement, I think are going to play a big role in helping with this standard. Information technology should have a grasp on service contracts. What assets are we leasing under IT arrangements? Certainly departments with numerous assets like our public works, public safety, and really even legal should be made aware of this standard. I would suggest holding meetings. Your lease team hold meetings with people outside finance to help them identify items to look for. I think one of the key departments there is going to be purchasing and procurement. There's going to be, finance already works with them a good bit on these issues, but there's going to be some education, I think, for our purchasing and procurement folks what to look out for in this standard. But I think a lot of people do need to be involved, even if you don't think you have a lot of leases to start. What do we need to gather exactly? Well, certainly any existing leases out there, what do we have on the books? All our capital leases, our operating leases. Look in your reports. What is currently disclosed in there? We may have operating leases that we've deemed immaterial in the past that aren't disclosed, but we need to at least gather all of those into one inventory and start there. In addition to documents that say lease in the title, contracts are another thing that you're going to have to be thinking about, right? Any contracts out there that specify the use of an asset could potentially fall under this standard. And that's what makes it a little bit scary, to be honest. But when you're looking at those contracts, the question is do they specify us using an asset? Do we as an organization have control of that asset? Control probably meaning, are we receiving benefit by using that asset? So again, not only leases, but potentially contracts out there where we are using assets. Service contracts are another thing to gather. IT and procurement may have a pretty good handle on these and what has been entered into that may be applicable for this fiscal year. Really need to create an inventory of known leases and potential leases. Once we get all these documents together, let's get them in one place. And one thing I've heard in a number of CPE training sessions, and I really think it's a good idea, hence this gentleman over here with the exclamation point, consider going ahead and obtaining information for those subscription-based information technology arrangements. They call that SPITA, which is kind of interesting. But that's going to be effective, believe it or not, next fiscal year. And that standard is very, very similar to this lease standard. So as you're gathering leases, as you're gathering those contracts, I would talk with IT now and say, what do you think we have as far as subscription-based information technology arrangements? Pull up that standard, and I would honestly start tackling that now. At least get the contracts together and start looking at them. Why not tackle both? Is really what I think. Probably the biggest issue you're going to face, and as auditors, this is definitely going to be a chief concern of ours, is have all potential leases been captured? How do we tackle this issue of completeness? How do we know we've identified everything? Well, like I said, we have to talk with our departments. We have to know what's out there. Certainly anything called rental agreements, you want to look at those. Another way to identify them is to look at your general ledger detail, looking for recurring consistent payments with vendors, monthly payments, quarterly payments, consistent payments. Anything called rent expense or lease expense in your general ledger, need to find out what that is about. Routine transactions, that are happening again every month for the same amount could be an indication of a lease contract. And there may be other data extraction methods out there. One thing we do as auditors, and I think is a good idea for everyone on this call to think about, is really looking at those board and council minutes for significant agreements. That kind of gives you an eyeball or a method to potentially identify contracts on the onset when they're entered into and agreed and approved by your boards and councils. So lease completeness, a really, really big issue, a hard issue to tackle, but hopefully by doing some of these, you can get comfortable with that. Another big issue that I think is going to be hard for folks is this notion of embedded leases. What exactly are embedded leases? Well, it's a lease agreement that exists within a contract. Again, it may not have been identified in prior service arrangements. It may not use the words lease or rent in it. There may be some judgment required when you're looking at these. Again, do we, as the lessee, have decision-making rights over some type of asset? These embedded leases, completeness was a big concern with the implementation of this standard on the FASB side. For public companies, this standard has been effective for a couple of years, and there's been some studies done of what were the biggest issues people had. One being just gathering them, of course, the completeness of the lease population, and then these embedded leases within the contract was also a huge issue. So, what are some of the sources of embedded leases? Any agreements that bundle a service and a device concurrently with each other, need to look at that. IT arrangements, again, are known to have some of these embedded leases within them, though they may fall under that new standard coming out next year. So embedded leases is really another key issue to be aware of as you're gathering this information. Once we've gathered what we think are all our leases or all of our contracts, you may want to start a spreadsheet or create a database of some sort. We want to get the key terms and out of these leases and contracts. We certainly want to know the start date, end date, payment terms. If there's an interest rate disclosed in that agreement, certainly want to mark that down. Copies of the agreements. Hopefully we have those. It'd be good to keep them all in one vault for reference, and not only for us, but your neighborhood friendly auditors. We usually like that stuff too. Once you're reviewing those leases and contracts, we need to determine, are these leases or are these financed purchases? To figure out if it's a financed purchase or not, does title transfer at the end of this agreement? We used to have that term called bargain purchase option in the standards, where, say, we could purchase that asset at $1 or $2 at the end of the term. If that is in some of your contracts, some of your leases, you actually just treat it as a lease until that option is actually exercised at the end. On the next slide here, I've got kind of a breakdown of considerations of leases versus service agreements. I thought this was helpful. This is from the Center for Plain English Accounting Guidance. It's a service we use that helps us with research and so forth. But I thought it was a pretty good tool if you're analyzing contracts that may be service arrangements, what characteristics a lease might have versus a service contract. So just wanted to include that here as a reference for you all. Again, still reviewing these leases and contracts. Does the contract itself have lease and non-lease components like maintenance? I know a number of them do. The requirement, and this is a requirement, you have to try and determine what is a lease component and what is a non-lease component. There are some examples of these in the implementation guidance. Maintenance is one that pops up some in the implementation guidance. So if you have contracts like that, look to that guidance on what could be applicable. One interesting note: GASB does require us to try and separate these components, while FASB, on the other hand, gives an option to combine them. If you get into a situation where it's just really not practical to break these out, it's almost impossible, I think there is some leeway within the GASB standard, but it at least needs to be considered. If you do end up combining those lease and non-lease components, obviously that's going to make your asset higher, but it's also going to make your liability if you include those.
Hey, Matt, real quick,
Yeah.
your screen is back on the first screen.
Oh, okay. Thanks for letting me know.
All right, we're back. We're on
Good.
reviewing leases and contracts.
Cool. Thanks. Technology is awesome. Okay. Thanks, Alexa. What was I talking about? Okay. The lease term is another thing we'll get into in some of the examples, but that is a key thing we need to document here. What are the renewal options? Certainly need to know that for calculating that initial liability. What is considered short term? Again, if we have non-cancelable periods less than 12 months, those leases may be short-term leases and don't have to be capitalized and the liability reflected. If you have a lease that has multiple underlying assets within it, maybe it's a lease for a building and equipment within that building, just need to try and allocate that price to each if you can. That is a consideration and requirement of GASB. If you can't, if it's not practical, you are allowed to treat it as a single lease unit. Payment information. So again, we're still looking at our leases and contracts. There's a lot of guidance on what payment information we are looking for. Of course, we want to figure out what are our fixed payments. If we have payments out there, what are termed variable payments that are based on something like CPI right now, We do start with what is CPI and assume it's going to be that for the term of lease term. If you have changes in CPI over the lease term, you actually don't account for those in this initial calculation. Those are just going, if you have changes each year, that's actually just going to be expensed in that period. I know the CPI was up 7 or 8% this year, so that change from the initial calculation would not be reflected for this year. Any minimum payments out there that are in essence fixed payments, you need to include those. One piece of information to remember: if you have expected payments that are going to be based on usage of the asset or future performance, those are actually, you're not going to factor those in now to your initial calculation. Those are just going to be expensed in that period when you incur it. The example GASB gives in the implementation guide is an additional payment based on mileage, for example, leasing buses in a school system. You don't know what that is now, so you're just going to expense it in the period that's incurred. A couple other items here to capture that I'll just list for now, but really any payments you know of that you feel is going to be reasonably certain, you may need to think about that in calculating this initial liability. Another topic that has confused some people, and really rightfully so, and ended up being more complex in the FASB implementation that I'm sure we'll face a little bit of, is this notion of what discount rate to use when getting those values back, calculating that present value. Certainly if it's already in the lease, that's ideal. So we would use what's stated in the lease. If you have existing capital leases already on the books, you continue to use that rate in this calculation. You don't use the rate at the implementation date, which would be 7/1/21. Again, if you don't have a rate listed in your lease agreements, you use what's called the incremental borrowing rate for a similar asset. If you were to go to a bank and lease copiers or a vehicle or some sort of equipment, that can be the rate used, and you would use the rate at the implementation date, which is 7/1/21. Unlike FASB, we can't use a risk-free rate. That is allowed on the FASB side. That is a pretty low rate each year. And then another issue to remember: if you're leasing different underlying assets, the rate could be different for those assets. A rate for a building or a rate for equipment could be different if they're commingled together. So just something to think about. With that, I think we have our first polling question. So really curious to see your answer here. Where is your organization on implementation? So I'll let you all answer that.
Okay, the first poll is being launched now.
Have you started? Have you not started? Are you finished? Are you working on entries? Are you done? And disclosures drafted? So we'll see.
Okay, the poll is closing. Alrighty, Matt, can you see the responses, or would you like me to read them back?
Yeah, you might read them to me. It's not very
All right, the winner at 59% was have started lease and data gathering process.
Great.
Second place at 27% was have not started. Third was 11% finished gathering and in process of analyzing data. And then 3% was done and ready, 1% working on journal entries.
Wow, done and ready. Good job, everyone. That's great. We should send some kind of Brown Edwards gift to those folks. That's good. That's good. But it is good to see the vast majority of everybody has started this process. I know that makes us as auditors feel a little bit better. So thanks everybody for that input. Okay, where are we at? All right. So we've gathered all our leases. we've talked about what we need, the terms we need to pull out of those leases. Let's talk a little bit about internally some of the policies, procedures, and documentation we should consider. So materiality consideration comes up in questions we get, and it is a good question. GASB does talk about it in the standard and in the implementation guide. So there's some good questions and answers in those. It could definitely be established for this and could be established internally, whether it's going to be based on total assets, total liabilities, individual thresholds for each lease. Capital asset thresholds are definitely can be a starting place. You know, the standard talks about, though, even if we have those thresholds, what is our obligation going to be? How material is that obligation? As auditors, as users, if we're not capitalizing these, if we're not showing that liability, the big question is, what is not reflected on the books that really should be? What liability is not on the books? So highly recommend you run this by your auditors. Talk to your auditors if you have a ballpark figure of what that non-disclosed liability might be. I think that's a really important conversation for folks to have. There's been some questions out there about individual and combined assets. And interestingly enough, the latest implementation guide, you all may have seen it, but there's a question in there about thresholds for individual assets versus combining those assets in aggregate. I can tell you, and I think GASB is going this way, they want you to combine those assets together and aggregate them and then determine if that amount is material. So just something to be aware of if you're trying to set thresholds for capitalization and the liability moving forward. But again, it would be good to establish a policy on that. Internal controls are probably going to change a little bit. You probably already have controls set up for debt, for example, certainly for capitalizing assets, but there might be some changes you're going to need to update. Certainly need to document approval and review of these agreements, preparation and review of the calculations, reconciling it to the general ledger. Do we have compliance issues? Do we, as far as reporting to external stakeholders? Are the duties amongst review, approval, recording, are all those properly separated? And you know, getting a sense and documenting how this process is going to work each year. You know, we're going to have a lot of work, a lot of time getting to implementation and transition, but this is going to be an ongoing compliance issue for all of us. So how are we going to do this? Are we going to gather information throughout the year, get everything in as it happens throughout the year, once a quarter, every month, just once a year end? My advice would be more than once a year would probably be a good strategy. This is going to be an ongoing compliance issue for everybody and making sure we're adhering to it. As far as review of those agreements, again, you're going to need to set up individuals or teams to review these leases. We're going to have to figure out if they're short-term leases. We're going to need to figure out the components of the leases, capitalization thresholds, and so forth. Here's a handy dandy flow chart, but you know how it typically, I envisioning it working. Someone is going to have a need for an asset, whether it's a department. Procurement's going to work on that need, terms. Finance is going to have to review that potential agreement, probably in between here. And what's going to be new for finance and accounting, or even procurement, if you can delegate that responsibility. But accounting's certainly going to need to look at the lease components and this standard when reviewing those contracts. Again, it's probably pretty similar to the process now, just need to add in GASB 87 requirements. And I think the key here is just accounting and procurement probably sitting down and talking with each other on what we need to get documented in these contracts for us to properly account for these. Policies to consider, we talked about the capitalization policy. Like I said, educating procurement to make sure terms are as specific as they can be in these contracts. The specific asset we're going to use, the rate, get a rate in there if you can, or base it on something that's very clear. Certainly making sure the periods are all disclosed in those contracts. Anything to renegotiate out there that we already have? Do we have leases that we should get out of and just buy the asset, or should we finance the asset? What are going to be the best decisions for us internally? Policies to think about. I'm sure a lot of you have started to think about software, depending on the number of leases you have. I like the idea of software and using software. There are some great companies out there. I've sat in on some of their sessions and thought they were very helpful. These folks are, I think, could be a resource for a number of you if you have a lot of leases. If you only have a few, may not be worth the cost or the time, but if you have a number of leases, I think there are some advantages to that. The software, from what I've seen, is a good place, a good database of the information. We can keep it all there. Certainly can assist with journal entries, review of those entries. Disclosures can even be populated from that software. Certainly gives us as auditors a trail when going through these, and there may be some efficiencies gained. You know, anything we can take off our folks where software might help could be a good consideration. Like I said, there's a number of vendors out there. You've probably been contacted by those vendors, but there are a number of out there that I think could be beneficial for you. One thing to consider is documenting, as far as really documentation, is creating a memo of your approach of implementation and how you addressed it. We've talked about all these key aspects. How did we address the completeness of leases? Who did we reach out to? Who was involved? What departments were involved? How did we evaluate each lease and contract reviewed? Again, I don't know if a spreadsheet is the best way to do it, but you know, lease over here, and then populating all the terms to the right of that in a spreadsheet might be a good way to document everything. What did we decide on materiality? What did we calculate that materiality to be? Our incremental borrowing rate, if it's not stated in our lease agreements, how did you come to that decision on how you're going to approach that and why? What changes and controls did you make? Is definitely going to be important for us as auditors, but internally, I think it's good to document that stuff and just have a clear plan of who's doing what are we doing that's different, and making sure everything is recorded correctly. So yeah, that was policies, procedures, and documentation. The next portion here, we're going to look at a couple different things. Recording these assets and liabilities, both throughout the year and at transition is one that's a little bit interesting to me. So had to dig a little bit here, but a reminder, the transition date for this standard, if you're a fiscal year end 6/30, is the transition date is 7/1/2021. The cumulative effect should be a restatement of beginning net position for the earliest period presented in your financial statements. If it's not practical to restate all prior periods, the cumulative effect should be reported at this restatement, should be reported as a restatement of net position. If you do have comparative statements, just remember that 2021 data is going to need to be restated for this new lease standard. GASB has said, thankfully, that you do not need to go back and figure out what lease liabilities you would have incurred years ago and bring those forward to that 7/1/21 start date. The adjustment should be made by gathering all that lease information and then calculating what that liability and asset should be as of 7/1/2021. If you do not restate or it's just too tough, you are allowed to disclose that reason, but of course, as a caveat, GASB says it's not really an inconvenience question. It's not supposed to be inconvenient. You need to try and do it if you can. Obviously, if prior periods are not restated, the asset should be calculated as of 7/1/21 and on. You do not have to go back and figure out if you had a lease asset years ago and what that value would be if you capitalized it and amortized it in prior periods up to 7/1/21. So we'll go through some examples here to think about, but how I thought about this was, even in this current fiscal year, if you've been recording rent expense in your general fund, for this fiscal year, going back to 7/1/21, should that rent expense really be principal payment, interest payment on your general fund? So those are the restatement things to think about, I think, this year, and we'll go over some examples there. I contemplated trying to go through a real comprehensive transition example in these slides, but I thought it would add just a little bit too much. There is a good example on the GFOA website if you have access to that. It's called the pre-existing lease contract. I've included a link here for that. It's an Excel sheet, gives lots of information, lots of scenarios. It gives you entries for getting this thing implemented, and then some post-implementation journal entries too. I thought it was pretty good. Again, some tidbits from that, some points to remember in your governmental funds for this fiscal year, 2022. Just make sure to double check rent expense versus principal and interest, or should it be principal and interest this year? Just really a classification question, I think, on your income statement for your governmental funds. Certainly in your government-wide statements, your full accrual statements, we need to get that lease asset, that lease liability on the books as of 7/1/21, and then modify the balance as of, certainly as of year end once we get there, but trying to make sure we're properly capturing principal and interest payments versus what may have just been simply rent expense throughout the fiscal year. Again, if you have comparative statements, and those are going to be presented, you're going to need to make sure we're restating rent expense if we need to, interest expense, showing those lease assets and the liability on our balance sheets. And don't forget about the effect on cash flow statements. You know, typically rent expense is going up under that operating section up top, while interest and principal payments are of course in the capital and finance related section. Something to think about. From the implementation guide, I did want to throw this in here. I thought it was important. So let's say we are implementing this on July 1st, 2021. We had a lease that started 1/1/19, but ends 12/31/21. So we're talking about 6 months there, or 7 months, July 1st through the end of the year. We're not showing any prior period financial statements. Is that a short-term lease? And the answer is yes, because the non-cancelable period is less than 12 months. So if you have leases that are ending throughout 2022, you do not need to go back to July 1st, 2021 and try and capitalize those and show the liability. So I thought that was good information for everybody. We talked about some of the tools out there. There's vendor software for calculating these. There's GFOA leases spreadsheet. A number of states and state treasurers, I've even seen examples of spreadsheets. Of course, you can come up with your own Excel spreadsheets to calculate these amounts. The lease liability itself, if you remember, is the present value of the minimum lease payments over the lease term. We've got our inputs of the term, the payments, discount rate, and purchase options. One thing to note on purchase options in the leases, we're only going to include those in the payment information if it's reasonably certain we're going to exercise those. Lease term, again, just wanted to have a visual representation of what to think about here. The non-cancelable period, options to extend, and options to terminate if it's controlled by us or the lessor, if we think those are not going to be exercised. Payments, here there are a number. We had that whole slide of what payments could consist of, but I'm guessing a lot of these here are going to be the more common ones for everybody. Of course, the fixed payments, less any incentives we receive as a part of entering into those leases. You may have variable payments like we talked about based on indexes or rates. Some of you may have an exercise price to purchase that option, that asset at the end. again, we would want to discount that back as well, and we'll show you that in an example. The right to use lease asset, we start with our calculated lease liability plus any payments made at before commencement. Any initial direct costs we incur by the leasee, those are actually also going to go in the calculation of the asset, and we'll look at an example of that. One thing to note, if we have any costs attributable to negotiating or arranging that lease, like legal costs, we're not going to include those as initial direct costs. So if you're like me, examples are good. They're not always, I tend to fade away a little bit when going through examples in these trainings, but my hope is you could come back to these, hopefully as an example, as a reference item when you're trying to get everything recorded. In this example, we're looking at a lease that's going to be for 5 years. And just a caveat, this is from the GFOA Leases tool, so I didn't reinvent the wheel on calculations. It is online too. But we're going to have payments of $1,000 a month. We're going to have some initial direct costs to get that equipment ready for use. There is a purchase option at the end of the lease that we think we are going to exercise, so that's important information. We've already calculated the present value of the lease payment, so $55,791 based on a 3% rate. We also need to present value back that purchase option we think we're going to exercise at the end, the $2,000. That comes out to $1,726. Another piece of information that's going to be useful is the estimated useful life of the asset itself is actually 7 years, which is greater than the term of 5 years, and I'll show you why that's important. The lease liability, again, is going to be the present value of the lease payments and that purchase option. We add those together to get our initial lease liability. To get the asset, we start with our lease liability, and then, like I said, we incurred some initial direct costs, $2,500 to get it into service. So our asset is actually higher than our liability in this example. Journal entries in your general fund are actually pretty consistent with what we've done for capital leases in the past. We need to show capital outlay expenditures of $57,517. That's the lease liability calculation. And the other side of that is our other financing source, lease inception. We also expended $2,500 in those initial direct costs. That also is a capital outlay item on our governmental funds. On the government-wide side, of course, we need to reflect the lease asset and the lease liability. So debit lease asset, we need to reverse that expenditure we showed on the general fund, and then for the liability, we need to book the liability and reverse out that other financing source. An alternative entry could be below, simply booking the asset itself, the liability, and getting it on the books that way. What do we do for recording our principal payments? Again, very similar to what we've done for any debt in the past, record an expenditure under debt service, both for principal and interest. And in these examples, the first payment was at the beginning of the lease for $1,000, so it's all principal to begin with. The second payment in May, of course, is based on an amortization schedule for principal and interest, so some interest reflected there. On the government-wide side, of course, we're reducing our lease liability each time for each payment. In May, we've already reflected that interest expense on our general fund, so we don't need to reflect that on the government-wide as well. One thing here in your slide, I think your slides probably show, if you downloaded them yesterday, this entry at the bottom on April 30th, the first month of amortization expense. Because we are and have decided or think we're going to utilize that purchase option at the end, we're going to buy that asset at the end, you actually do need to amortize this asset over the useful life as opposed to the lease term. So that is a change I made in these slides. I'm sure, Alexa, we can send these back out if people want that, or you can just make a note in yours that it's going to be the lease asset divided by the number of months of the useful life as opposed to the lease term. So $1,714 versus the $1,000, I think was reflected. Okay, next polling question. How do you plan to track and calculate all these liabilities and assets for entry?
Okay, launching the poll now.
going to purchase outside software? Are you using your own financial software? Are you going to use templates, or are you going to use the good old-fashioned green bar ledger manual calculations?
Closing the poll. Okay, Matt. So the winner at 68% was use of Excel templates.
Okay, good to know. Good to know. So we had 0. Did we have anything for green bar manual calculations? I can't see.
We had 1% for green bar.
Okay, good, good. Technology is advancing fast in that company. So congratulations. I hope we don't have to audit that one. Actually, that could be a little rough. Thank you all. That's good information. Okay, there is also an example here on the lessor side. The lessor is going to keep the asset on its books at its carrying value. We're going to record a lease receivable, which is going to be the expected lease payments over the term. The other side of that is going to be a deferred inflows of resources equal to those payments, plus any payments received at or before the lease term. You are going to continue to depreciate the asset over its estimated life. And over the term of the lease, we're going to recognize both rental and interest income related to it, and we're going to amortize that deferred inflows of resources into revenue each time. So again, some examples here. On the lessor side, it's for a lease of 10 years or 120 months. We expect to get $3,000 per month due at the beginning. We are going to get an initial payment of rent at the inception of the lease, so going to need to factor that into our total. Our total cash due is going to be $357,000, which is, of course, all the monthly payments minus that $3,000 amount we're getting at inception. We've already calculated that the present value of those future payments is $316,000 based on an interest rate of 2.5%. And then the estimated useful life of the asset we're leasing is a building, $10 million building. The useful life of that is 75 years. And again, this is one from the GFOA leases tool, so you can pull it up online and walk through it yourselves as well. So our initial lease receivable going on the books, again, is going to be the present value of those future lease payments. The initial deferred inflows of resources is going to be the future lease payments plus that initial rent we got at inception of $3,000. Entries in our general fund are going to be a lease receivable with an offsetting deferred inflows of resources of the $316,000. And then we received that initial payment for the last payment on the lease of $3,000. That's of course cash that came in. The other side of that is deferred inflows of resources as well. Journal entries when we received the first month's rent. It began on July 1st. We also got the first month's rent. Cash came in the door. The offset to that is entirely principal on the lease receivable. And then we need to amortize the deferred inflows of resources on a monthly basis over the term of the lease. That's 120 months. So we're going to reduce that deferred inflows of resources and recognize a little bit of lease revenue for that first month. We also need to, of course, reflect depreciation on our government-wide statements. The second month in August, we have cash coming in, the payment of $3,000. Of course, this time we have a little bit of interest earned. So part of that payment is reducing the lease receivable. Part of that payment is recognizing some interest revenue. We need to amortize that deferred inflows of resources again over the lease term. So credit lease revenue, debit deferred inflows of resources. That's all, of course, based on an amortization table. All right, so that's recording in transition. Hopefully that's helpful, and hopefully you can come back to it as you're thinking how to record everything here. The next couple slides are some points. GFOA has actually looked at some of the early implementers out there, so kudos to those folks who have done that. A couple of reminders that I thought were relevant for everybody here, just to remember that On the statement of net position or assets, lease assets are considered capital assets. You actually don't need to break out lease assets in particular on the statement itself. You can include it in those categories. Depreciable, non-depreciable, that's really where they should be. If you do break them out, if your statement of net position has classification, i.e. buildings, equipment, furniture and fixtures, all of those categories, the related lease assets would be grouped under those as well on the statement. The lease obligations should be reflected under long-term liabilities due within 1 year or long-term liabilities due in more than 1 year. It's interesting, there's not a lot of examples out there on this standard. The standard itself gives a little bit of guidance, but hopefully if you have capital leases, if you have operating leases, you have some of these set up already. So there's just going to be some tweaking as a part of the standard. But I think the point here is you don't need to break out lease assets on the statement of net position itself. So remember that. Lots of disclosures, as always. Some of these are pretty similar to what we've had in the past, but a general description of the leasing arrangements you've entered into. Total amount of leased assets is important to remember. We have to show that in some way. We also need to show total leased assets by classes, so leased assets, buildings, leased assets, equipment. That is a required disclosure. And on the debt side, future maturities of principal and interest will also be required. And that's kind of what this slide says here. Again, in the disclosures themselves, we just can't have one single line item disclosed for leased assets. We need to break those out and disclose those in total somewhere. You can either group them all together and disaggregate them by major asset class, or maybe within your capital asset table, you can identify them leased building, lease asset buildings. Like I said, they just have to be disclosed. It also makes sense with these lease liabilities and your long-term liabilities disclosure to have them in there as well in the roll forward, along with, of course, principal and interest tables. The lessor side, here's some information on that. Again, basic terms, inflows for the period, lease revenue you recognized, interest revenue you recognized, if that's not clear from the financial statements themselves. If you have significant leases, both lessee and lessor, you probably need to have separate disclosures for both of those. There are some requirements in the standards. If you have leases that are considered investments, regulated leases, subleases, sale leaseback, leaseback, there is some guidance in the standards. I didn't add them to these slides, but there is some guidance in there on those as well. Last polling question of the day. What types of leases do you think you have or know you have?
Launching the poll now. Closing the poll. Okay, Matt, our winner at 48% was a mix of both, and primarily the lessee was a close second at 38%.
Okay, very good. So I'm certainly going to have some lessor disclosures to get in there and making sure we're accounting for all those right as well. Interesting. Okay, a couple last thoughts here, almost done. What to expect from us, your friendly neighborhood auditors. We're going to be asking questions on this standard, as you can imagine. I talked about creating that memo. We would want to look at that memo to see who you involved, how did you address those embedded leases, the completeness question. We as auditors are probably going to grab your general ledger and do those same things. We're going to do some searches for recurring payments. and ask the questions, are those leases, were those captured? We may look at entries you've done, both at transition and what you're doing, if you're doing anything new. Certainly, what are your new processes, controls, policies that you implemented in relation to this standard? How did you figure out the borrowing rate? How did you calculate and determine materiality? And again, get with us on those calculations and make sure everybody's comfortable moving forward with those. If we assist you in preparing your report, we will need lots of information. We're going to need total lease assets and by class, certainly principal and maturity requirements, all those other disclosure items we talked about. Really can't rely on us to calculate your lease assets and liabilities. We are certainly happy to answer technical questions as you get them. If you come across a lease that's complicated, we're certainly happy to be there and give some input on those. This standard is interesting compared to OPEB and pension over the past couple of years. That information, as you all know, was coming from VRS, was coming from the APA. You know, really was up to us to allocate those amounts, get the disclosures right. This is really a significant standard that's really up to us. You know, we've got entries we need to figure out, disclosures. The evaluation is really going to be up to you all. And again, we're always happy here to assist and get you through it. So in conclusion, as you can probably tell, this is a significant standard. I think we all know that. I've sat in some other sessions where people have said, well, it's about 1 to 2 hours per equipment lease review, 2 to 3 for real estate leases. So there's just lots of information to gather. There's lots of information from each lease. So keep that in mind. There is some additional guidance out there on modifications, terminations, requirements for remeasurement. That all will need to be addressed in subsequent periods as you're addressing these leases. And the time to start is now, if you have not. So that's all I have right at 10 o'clock. You know, if you have questions on these, feel free to shoot me an email. Each client and each client's situation is different, so we're happy to try and tackle that together.